Hi, this is Eric Boyce, CEO and Chief Investment Officer, and welcome to Charts of the Week for February 15th of 2021. Please share a disclaimer for important information. In our typical first chart of the week, we cover the coronavirus and the 7-day moving averages. As you can see here, we've had some tremendous progress in the data from the beginning of the year. We can see that blue line consistently moving down. We're beginning to see the orange line, which is a 7-day moving average of daily deaths, begin to roll over, which is typical of the lag that you see between deaths and infections. So positively trending here. Obviously, we've got vaccines we're going to talk about, but clearly the rate of infection on a 7-day moving average is looking really good relative to where we have been over the last several months. Just a quick update from the CDC on vaccine doses that have been administered. Now, these are raw, essentially aggregate doses that have been administered, not necessarily like second doses. We've got another chart for that, but here we can see that it's estimated that we've delivered about 45 million doses. And when we did this chart last week, we were about 34, 35. So we continue to track. We've got another chart that'll show you the progress that we're making on ramping up the vaccination process. Good news here and continuing positive trends. Here's our path to immunity, put together by First Trust, but data coming from covidtracking.com and CDC, as well as Bloomberg. And so like we've described to you in previous weeks, the rate of estimated share of population with the COVID-19 antibodies continues to increase on a weekly basis. You can see the blue line represents positive tests, and those obviously have been eking up, as we know, even though the 7-day moving average, as we just saw, is rolling over. But CDC estimates that there's a 4-to-1 ratio for folks that have tested positive to those who likely have the antibodies that perhaps were exposed to the virus and were infected but didn't realize it, that were asymptomatic, so on and so forth. And then the green bar, as we've described to you in previous weeks, represents the vaccine doses administered. So that number is going to continue to rise, and I've said that number is going to make those the gray and the blue almost pale in comparison before it's all said and done. As a result, the estimated share of the population with antibodies is now roughly about 40% by the CDC's measure. So, again, continued progress on the fronts to kind of get us to, or at least get us closer to being able to open up fully with this herd immunity concept that we've been talking about consistently here over the last several months. This is more data from CDC that just kind of shows you the percent of the total population that has received at least one dose. And you've got some kind of shaded or lightly shaded lines that represent a lot of different states, but then the solid line that you see there is a U.S. number. And so where we are now, there is about 10% of the total population has received at least one dose. And so that's consistent with what you saw in the prior slide. And the good news is that number has a fairly consistent upward slope when you go week to week. Now, when you break down the weekly data, obviously there's a daily noise within that data, but the real key thing here is we had some fits and starts at the beginning, but the 7-day moving average, which is that orange line, with some little retracements there, generally is continuing to slope up. We're delivering more vaccines every week, and it's certainly a greater number of vaccines that were delivered the prior week. So that means that distribution is becoming more efficient. It's becoming more plentiful. Obviously, there's a lot of news flow now about getting vaccines down to the pharmacy level and Walmart and some of these other mass delivery points here in our own backyard in Central Texas. We've got one of the high school football stadiums. It's serving as essentially a mass inoculation center. So greater efficiency here, which is a definitive plus. And from First Trust, we have our high frequency data. And I don't think we've shown this in a couple of weeks, but the data is kind of what you would expect. Some areas that are doing well, TSA checkpoint data over the last week was positive. It's a slightly negative over the last month, but that's kind of tailing off after the holiday kind of surge that we had. Motor gasoline sales, we've got more drivers on the road, so that number's up both on the week and the month. Restaurant data has been a little bit more choppy. Again, that data is going to continue to have noise in it until we can get closer to herd immunity, and then we have a clear path to creating excess capacity in our hospitals, which like right now, some areas and even in our own county here recently, we were at an bed occupancy level in the hospitals that mandated increased restrictions for a period of time. So eventually we'll get past that and that data will look better, but right now it's a little bit noisy. The hospitality industry continues to have good weeks and bad weeks, and right now that data is also noisy. And then I just say, from a labor standpoint, we've had some decent weeks, and we had some consistency in the data in a positive way heading into the fall, and the data has been a little bit less conducive lately, just with the theory that we're probably kind of hitting some speed bumps on this road to recovery with regard to labor. And we know that the unemployment rate fell despite lackluster jobless numbers, but the unemployment rate fell largely because we continue to see a lot of people leave the workforce for various reasons. And even though jobless claims, the data was positive over the last week, and on balance positive over the last month, there's still challenges in the labor pool. So I want to talk about the consumer for a second. There's a lot of opportunity for the consumer to play a part in the recovery in 2021. Right now, there's some uncertainties out there. You can see the sentiment index, which has picked up off its bottom. It's well below where it was over a multi-year trend. We've talked about this and we've shown this data in this chart to you in previous weeks and charts of the week. But it's important to realize here that this data is going to have its ups and downs again until we get to a more visible sign of being able to open up the economy closer to 100%. And Consumer Expectations Index is tracking in a very similar way to sentiment. Now, I keep saying this, but it is true that it has much more to do with consumers actually do than what they say they're going to do or what they expect they're going to do. Right now, a little bit of trepidation. We do not have the stimulus ironed out yet. We're getting closer to it by the day. It does appear that it's going to be a higher number than we thought before, because it does appear that the Democrats are going to use budget reconciliation to get it through on basically a simple majority vote. And so what that means is that the stimulus package will be a little bit more robust, and my hope is that it's a little bit more targeted to the individuals who really need it. That being the lower income cohorts, which we've shown in these charts of the week in the past, that those are the people that tend to spend it. And the higher income folks tend to save it, and so that money is not in circulation. It's not driving that money multiplier. It's not necessarily boosting the economy in terms of consumption. Personal financial expectations here. Again, that just dovetails. It's a chart with data from Piper Sandler, a super regional investment bank, and this data is actually pretty interesting. And this is, personal finance. So we've seen a lot of balance sheet improvement on the part of the consumer. Some of the savings have gone to retired debt. Some of, clearly, mortgage, defaults are really tempering. I think much more so than we thought they were going to be at this time a year ago. However, personal financial expectations still are in the rut, and I think this kind of looms as a very modest anchor over economic growth. This synchronized global recovery that we've been talking about consistently, and this is both a kind of a challenge and an opportunity. That this type of number right here kind of puts maybe tempers your expectations for what the consumer can do in helping to bolster this economy in 2021, but it also serves as a kind of a stark reminder of how powerful the consumer is at almost 70% of our total economy. And when you look at net worth and you look at the health of the consumer in terms of the balance sheet, this is a big reason why for most folks, in a very broad sense, the majority of their net worth is tied up in their home for those who are homeowners. And you can see the market value of a primary residence. This chart is fairly intuitive to anybody that's been watching these charts of the weeks over the last 6 months, is that we have had the residential real estate market has been a horse. It's prices are high. Affordability, thank goodness, is being helped. High prices are being offset by low mortgage rates right now, and so obviously the residential real estate market is very, very strong and helping to improve balance sheets for the average consumer. We're going to talk about inflation here for a second because we know this is coming. And it's already manifesting itself in some of the producer data, some of the flow-through data. We see input costs. We've got some commodity charts at the end of this presentation. And we've shown that there's too much liquidity in the system now that is trying to find. We've had production decreases, but we've had an increase in the supply of money. And so when you have too much money chasing too few goods, that is the perfect recipe for inflation. And so despite the fact that we haven't seen a lot of inflation over the last many years, it's been fairly tepid. I think we're on the precipice of something that is a little bit more meaningful. Right here in this chart, you can see in that blue line that we have the CPI year over year. And that's on the left-hand scale. So now it's not up to the 2% that the Fed wants it to be. And frankly, the Fed pays attention to personal consumption expenditures, not this more kind of public-facing number called the Consumer Price Index. But still, it's below where the Fed wants it to be. But if you look at inflation expectations, which is that black line, you can see that number is beginning to move higher. I mean, actually over 3%. Why is this important? Expectations do get filtered into longer term interest rates. So we've had an increase in the steepness of the yield curve, meaning that short-term rates continue to be anchored really low because the Fed says we need to see average inflation of 2%. Before we're going to raise rates. And that point was really reiterated last week by Fed Chairman Jerome Powell. Now, on the longer end of the curve, like 10-year rates, 10-year Treasury rates are much more influenced by what inflation expectations are. So what we see here is those inflation expectations are beginning to move higher, with lower rates remaining firmly entrenched around zero. And so we're seeing steepness in the yield curve. And usually when you see this, and you can see by this chart that there's a reasonably positive relationship between inflation expectations and the consumer price index. And so what this tells me is that we're apt to see inflation perhaps catch up a little bit with inflation expectations. And here we see now on goods prices. And we know that durable goods manufacturing has been strong. We certainly know that durable goods with commodity inputs like metals and things like that, and we've got a slide for that coming up, that those input costs have been going up. And so, there is a reasonably positive relationship here between the dollar, the U.S. dollar index, and the price metric, or the price proxy, if you will, for durable and non-durable goods. And so what we're looking at now is actually on the non-durable goods side. So a deflator is kind of another fancy way of saying, what is the implicit interest or inflation on the non-durable goods side. So again, durable goods, we know that there's input costs that are going higher. Non-durable goods, I think what we're looking at is that we have a lag between where the dollar is and where inflation is. And so usually when you have this, as you can see from the chart going back to 2000, that there's a catch-up, there's a true-up, if you will. So at some point you would expect with the dollar as it continues to remain weak, that you're going to have a catch-up with inflation, because a weak dollar would imply that of your imports of non-durable goods, you're importing higher prices because the dollar is weaker, right? So your foreign currency is higher. So you're essentially importing inflation. So this is where I think that we're going to get another area of potential impetus for higher inflation. Now here's a slide that does a good job of marrying up that net wealth increase that I've been talking about with what's been going on in savings. And so if you look at the blue line, that represents net wealth. And even though this is inverted, so with that number going down, that means that net wealth is going up. If you look on the left-hand column, you can see that net wealth is going up. At the same time, you look at savings on the right-hand side, and which is also moving higher. Now, you typically see a different kind of relationship, and so when you look at 2012, actually, you got to go back several years, and you see that divergence has really kind of taken root, and if anything, here over the last year has just simply exacerbated the prior year's trend. So, while it's positive to say that we've got net wealth, a lot of it is now, a lot of that wealth gain is tied up in savings, and so a lot of it is in liquid savings. And it's just kind of interesting that we have this impact here, after many, many years. I mean, this data series goes back to essentially, post World War II, and the tight relationship that exhibited for so many decades is clearly broken and really kind of widened out here as of late. All right, let's talk about earnings. So we've got on this, we have the MSCI US, and this is the green line is the long-term consensus EPS growth. So this is earnings per share over the next 3 to 5 years. And if you look at that and then plot that against the MSCI Index, which is not the S&P 500, but it's very similar in terms of its tone, direction, amplitude, those types of things. And obviously the market's gone higher. We had that hiccup as you look at 2020 and the gray, where that spiked down and then moved back up. But it's remarkable to see how earnings per share growth has really moved higher. And this is really kind of, in terms of its magnitude, really unprecedented. And, there are moments when I think, and I'm convinced myself that these estimates are too high and they're apt to come down. But frankly, I said the same thing about fourth quarter earnings here that are in the process of concluding, or coming to a conclusion here, and those numbers have actually been much better than expected. In fact, fourth quarter numbers that were expected to be, largely negative on the whole, have now actually turned positive. To the concept that, if we'd been sitting here 9 months ago and said that we're going to have fourth quarter 2020 earnings that are higher than fourth quarter 2019 19 earnings, you would have been labeled as outright crazy, but that's exactly what's taking place. So I think it does pay to buy in a little bit to, the concept of higher earnings over the next 3 to 5 years. I think that, to buy into that argument, you have to believe that we're going to be able to avoid a recession during that period. Now, I do think that growth over the time frame, after this bounce back and this kind of settling out period here in 2021, that growth is going to be a little bit more muted. I think as we get a little bit more inflation, that's going to put some speed bumps on the equity market, certainly going to impact fixed income. And, as we look at those types of things, it creates an environment where earnings can still go up, but it's just not necessarily clear that we're going to have the outsized growth that this chart seems to indicate. So we'll obviously monitor this as we move ahead. But anyway, just figured it was interesting to share. All right. In the S&P 500, we know that a lot of companies pulled in the reins. They did a lot of different things in response to the pandemic. They certainly pulled their earnings guidance. A lot of them did. Some of them have come back and kind of begun to reinstate their guidance based on improved visibility now that we're, getting towards the end of the crux of the impact of this pandemic. And they did a lot of other things. They did a lot of capital restructuring. They reduced dividends and things like that. But, so the ability for the market to kind of guesstimate what is going on with earnings, like in that last slide, we've had years, as you can see on this chart, where we've had a lot of companies in the S&P 500 issue guidance. And so the more guidance you have, kind of the more quote unquote visibility you have on where earnings are likely to go, because you're hearing guidance from management that helps to kind of shape and form your own expectations as an analyst on where earnings are going to go. But when you have fewer companies that are giving you that guidance, I think it increases the potential volatility of these estimates and the potential the potential that estimates may not prove as viable over the long haul as they have in the past. Notwithstanding that, though, we continue to see a lot of interest in the stock market, a lot of momentum in the market. These are weekly global equity flows, and this is a global number. It's not just a U.S. stock market. I mean, these are flows across world exchanges into equities, and we're in rarefied air here, as you can clearly see. A lot of enthusiasm over equities right now. And we've talked about this. We've shown you different charts that kind of say the same thing. One iteration of this would be to do the put call ratio, which would show the number of put contracts over the number of call contracts as an indicator of bullishness. Well, puts are options that make a bet on the market going down. It's meant to provide the owner of a put protection on downside. Now, the owner of a call is betting on the upside clearly. And so this number spiking up, it just tells you that there's a lot more option contracts that are being written to promote or to make a bet on the continued increase of the equity market. And if you go back to 2011, which is the time series on this chart, you can see a fairly consistent range until basically the beginning of last year, kind of right at the apex of the pandemic volatility. This is a chart on equity volumes, and so there's a lot of noise in the data. You've got in the basically you've got in the black line, you've got consolidated tape volume, and then in the red line, you've got SIBO, or Chicago Board of Exchange Volatility Index. So we've talked at length about how volatility remained very, very low for a long time. And that was consistent with volume levels, with some exceptions. We had a taper tantrum, and then we had, kind of a sovereign debt issue, which caused an increased volatility in certain markets. And we had little bouts of volatility, but nothing like we saw earlier last year with the pandemic. And as you might recall, obviously we had plenty of volatility at the same time that we had a lot of market of exchange volume of trading. We had raw trading that was high. Now, in February and early March last year, most of it was selling, and markets were struggling to find that bottom. They eventually did, and things went back up. But as they did, there was an inflection point there where volatility went down, and then volumes went down. But then volumes began to pick up. It's almost like the caboose pulling out of the train station, and you've got a whole host of retail investors. These are like you and me, retail investors that were chasing that caboose because they wanted to be a part of that growth. They could see the market had already recovered, 30, 40%, and they wanted to jump on that bandwagon in the worst way. And it essentially culminated in what we saw here recently with GameStop and AMC Theaters and Bed Bath & Beyond and some of these other poster children for how the retail investor is really trying to slap it to the institutional short sellers. And so this is very emblematic of the impact of retail investors on total volume, which in turn has helped to create additional volatility in the market that maybe we were expecting, but not expecting necessarily to come from the retail investor. This is a chart of the cyclicals over the defensives. Now, this just tells you that we've had a lot of emphasis already. I still think there's plenty of staying power in investing in the cyclical upturn in this new economic cycle. But what this tells us right here is that defensive stocks are really unloved right now relative to those cyclical stocks. Talk about fixed income here for a little bit. It's important to note here on both the 10-year and the 30-year Treasury, that we've seen moves higher. Now we know that the 10 and the 30, kind of these longer term Treasuries, have much more of an influence from, or I should say rather, are much more influenced by inflation expectations. And we know that that part is moving up. So accordingly, we've seen increases in these two long-term Treasury yields. And I think it's important when you look at it from a moving average standpoint. And it's a little bit of a technical term, but this 200-day moving average is kind of important. And we've plowed through it on both the 10 and the 30-year Treasury, which makes me think that this move is sustainable. So we've talked about credit quality, and we've talked about defaults and on corporate credit, and this is one that I found was very interesting. We've had a lot of issuance in the corporate credit space over the last year. A lot of companies trying to raise capital where they can. This is interesting because if you look at the left-hand side, those are all investment grade bonds, AAA bonds. Relative to triple B, they're just not nearly as plentiful. Much more paper is being issued at that triple B space. And we were worried that at some point last year that we were going to have a credit erosion to the point where a lot of those triple B investment grade bonds were going to slip to double B, which are not investment grade, and that you'd have forced selling by a lot of index funds that are beholden to own investment grade bonds, and we call those fallen angels. And so that trend actually really didn't play out as much as we thought it would. But suffice it to say that there's a lot of potential exposure if we were to have a credit shock and see downgrades. There's a potential that you could see a lot of those triple Bs move to double B. But that's something that we should definitely pay attention to. But the thinking, though, is that as we kind of continue along this migratory path of global expansion that we think that we're in right now, then the chances of that are fewer and fewer. This is something that I think should be of interest to folks. Now, this is duration by credit rating, and what is duration? Well, it's a measure of risk within fixed income. So the higher the duration, the higher the price sensitivity is to a bond to an increase in interest rates. And so, well, what does that mean? So as interest rates move higher, as yields move higher, prices go lower. That's the inverse relationship that we all know and understand in fixed income. So, but when you have a high duration bond, they're much more sensitive. They tend to fall in price a lot more when interest rates move higher than do short duration bonds. And we can see here that both AAA and BBB bonds now have an extremely, and these are indexes, data from Macrobond and Mizuho Securities, but they have really high durations right now, like 8-9 years. So I can just trust me when I say that that's high, and so there's a much more likelihood that people that own those types of bonds, the highest credit bonds, and actually triple B is kind of that solid, as we saw in the last chart, kind of that real thick spot on the chart where there's a lot of issuance out there, but a lot of that issuance is at high duration, and it is exposed to increases in interest rates. And that's important because as we see this inflation picture begin to evolve, and we've already seen where Treasury yields are moving higher and likely sustainable, then that's going to put a lid on fixed income appreciation potential. And it's going to put a lot more stress on the return from fixed income to come from yield. And so what's interesting in this is if you look at the double B and the single B, and these are below investment grade credits, that their durations are much, much lower. So what's interesting now is that you get almost a better risk profile and a higher return with high yield bonds than you do with investment grade bonds. This is the yield curve that I was talking about, and as we've seen here, this is just the confirmation to what I was describing before, in the sense that the yield curve has gone higher. It's been steepened because longer term rates are moving a little bit higher because of these inflation expectations. So we've got some commodity data here. Now, those of us watching this right now, as I look out my window, I see 6 inches of snow on the ground here in the Austin, Texas area. Temperatures are extremely cold, and that's really causing a spike in natural gas prices. Here's crude oil. We continue to see strength in crude oil. And on the right-hand side of this chart, I thought it was interesting that with all of the devastation in the energy sector last year with the collapsing of energy prices from the collapse in energy demand, that we're beginning to see that rebuild. So on the far right of that right-hand chart, you can see that the earnings from major oil producers are beginning to show some strength. When you begin to see the major oil companies begin to perform better in terms of their financial and operating performance, that's usually a harbinger that some of these lower tier folks are going to begin to do a little bit better. Certainly with prices being higher, they're more apt to uncap wells and begin to increase production. And the health of the energy sector, I think, is slowly improving here. And certainly these two charts on this page are an indicator of what we think, of the thought that we think is playing out. All right, some more commodity input costs. So as I talked about producer prices going higher, input costs going higher. Last week we showed a chart where producer prices were going higher, but end prices to the consumer were not going up as much. And we think that's going to change. We think that because of things like this, we've got cattle futures. So we know beef prices are moving higher. Cotton prices, we know textiles are going higher, even at a time where the retail apparel industry is really taking it on the chin. But these input costs are eventually going to have to filter down into the end consumer because there's only so much operating margin or operating profit that the producer is going to be willing to give up before they start really having to put this on the consumer. This is the LME or the London Metal Exchange Index. So this is kind of a composite index of industrial metals, if you will. And so you can see that that's gone through the roof. We know that, obviously steel, things like that, copper, in construction, steel going into durable goods. We know all of that's been strong here lately. So it should come as no surprise that we're seeing this continued strength in the LME index here. And again, just one more indicator that producer prices are going higher and going to eventually put pressure on end prices to the consumer. All right, and so I'd like to end today just with a kind of a quick observation, something I came across in the daily reading from the Pew Research Center. And this is how Americans get their news. And we know that has changed. And I think now you can by this chart, you can clearly see that smartphones, tablets, etc., have clearly eclipsed television and print publications, frankly, as the source from which Americans get their news. And these trends have been continuing to evolve for many, many years. And it's obviously made it much harder for newspapers to make money, even radio interest to sell advertising, as well as television seems to be holding its own. But clearly, the trend is well underway that the digital delivery medium has become the benchmark. That's all we have for this week. Enjoyed having you along with us. Welcome your comments and thoughts at the contact information you see there. Hope you have a safe week. Hope you stay warm this week for those of us in Central Texas and North Texas. And we will talk to you again very soon.